All right. Good afternoon, everybody. We're getting into the lunchtime hour here. This is Event Trader, and I'm going to introduce all the traders this morning that we have on the desk here. I'm going to be talking a little bit about the start of 2022 and some of the price action that we've seen over the last couple of weeks during the Santa Claus rally, and basically do a little bit of a catch up and then a look ahead for all our subs out there. So, with us today, we have chart trader Brett Manning. We have blue chip trader Scott Smith, trend tracker Craig Rapisarda, and we should hopefully soon have Damon on the line, just taking care of a few things on that front there. So, without any further ado, we're going to bring in Brett and talk a little bit about the overall landscape on what's going on there. So, Brett, how are you doing? Happy New Year to you.
Hey, happy New Year, Gavin.
So yeah, just want to take a little bit of a quick 5 minute broad look at the market. Then
Sure.
we're going to break down some of that price action, get some thoughts back from the other traders. But you always do such an eloquent job at putting everything into focus for us. So what are you seeing out there in the markets?
Okay, so I think that right now we've started off the year with two uh, kind of commingled reallocations happening in institutional investor world that are having a big effect on all sorts of markets. And so there's two things going on right now. The first one I want to describe, and Craig talks about this a bit as well, when you have rising interest rates, because the traditional long only equity fund manager model really incorporates something called the discounted cash flow model that impacts allocation from growth to value stocks. And I wanted to quickly describe why that is, really simply, without doing a lot of using terms like net present value or discounted cash flows or equity risk premia or anything else. It's simple to think about. If you think about rising interest rates, basically mean a higher risk-free rate of return for present cash flows from investments. So the point there is that translates into a higher opportunity cost or like a penalty if you're holding long duration stocks. And long duration stocks really just means this is like an earlier stage growth stock that's not going to generate a lot of cash flows for investors right now, but it will generate tons, several years out. So there's a duration process that you have to undergo before you start to get the return from the discounted cash flow model. So that you've got to weather that. And if in the intervening time the risk-free return of money goes up, then that's like an opportunity cost or a penalty for allocating a lot there. So that forces an allocation shift from growth stocks to value stocks. And value stocks are generally more mature in terms of generating and distributing cash to investors. So I mean, long story short, rising rates drives a reallocation in traditional long only equity funds toward less exposure to growth stocks and more exposure to value stocks. So you're basically going from future cash flows to present cash flows because the risk free rate of return is higher. So that's one dynamic that we're seeing right now, and you can see it in things like electric vehicle stocks and autonomous vehicle technology and genomics curative medicine and things where maybe in the year 2030 these companies are going to be making a huge amount, but they're not making any returns for investors right now in terms of just cash flowing to investors through things like dividends. So we're moving to Exxon and things like that where cash is flowing because you're extrapolating. So that's one dynamic that's going on. And I think the other dynamic that's going on is we've seen this a few times over the last few years when you see a few days where you get volatility to the downside in stocks and bonds on the same days. And at the same time, the volatility of the price of money is going up. That forces another group on Wall Street called risk parity funds to reallocate toward higher cash level. So you're seeing these two different reallocations going on. One is traditional long only equity fund managers are moving money, rebalancing toward value stocks from growth stocks. And the other one is risk parity funds are reallocating with a higher cash level. So those two things are the main things that we're seeing right at the start of 2022. And the driver for both of them is a volatile and rapidly paced increase in interest rates.
All right, I'm going to ask the others the same question, but Brett, while we have you on here, the Fed minutes yesterday obviously garnering a lot of attention. I know you had a comment, and I was kind of in the same camp that I didn't think that anything particularly new was introduced, but I know a lot of people are pointing towards the balance sheet unwind and then the time period between the balance sheet unwind and the first rate hike, which we saw in the CME Fed Funds futures yesterday, did move up to that March sector. So, what was your thoughts on the Fed funds and or the Fed minutes, and what are you going to be looking for in the short term from Fed speakers as they start making their rounds?
I mean, I don't think any. We saw this sharp pivot. The interesting thing about the pivot was that they're placing a higher priority. It would seem. I mean, there's two ways to look at it. One is just they're pivoting toward a more hawkish stance. The other one is kind of a little bit of a pivot from Wall Street to Main Street, and that seems to be kind of written into a lot of things that are going on in this world right now. But there seems to be a prioritization over inflation and inflation expectations and trying to calm that rather than worrying so much about asset prices. And that's, you can look at those two dynamics together as a really important kind of threshold experience for Wall Street investors. And I think that we're seeing, we've got the possibility of a lot of volatility that can come from that. But yeah, I mean, I didn't see anything new yesterday that we didn't know a month ago, really. Even before the last Fed meeting, it seemed like there was enough Fed speak kind of warming the turf for this transition that it was pretty clear that we were making this transition. And Fed funds futures moved a little bit, but not that much. Um, and euro dollar futures forward curve moved a little bit, but not that much. So it was interesting to see the reaction yesterday as if there was this new dynamic. And I think maybe it was just, again, it was just like a threshold experience. And maybe at the same time, because we're in a new year and we're seeing those twin reallocations that I just discussed, and that leads to these margin calls and everything else when you hit these threshold points.
Okay, we'll circle back to that margin call comment here in a little bit. But Scott, from your worlds on the tech side of things, what have you been seeing over the last couple of weeks? Obviously, the redistribution story has been prominent, but has there been any themes that you've seen sticking out to you?
Not particularly. Just it's more of the same, really. The market's done a pretty good job of keeping the status quo throughout the fourth quarter of last year, going through the sector rotations, maintaining the bullish sort of underlying tone, welcoming each pullback, and then buying it up at the appropriate levels. um Going into the new year here, obviously that same theme sort of rotates, same theme sort of carries over here with the theme of sector rotation. And we've obviously seen rates on the rise here, which hurts the overvalued growth oriented names, mostly in the technology and biotech arena, so they take it on the chin a little harder than most names there. And the money is rotating into financials, it's rotating into energy, which from a technical perspective, they all uh, basically settled down into a range over the course of the last couple of months, and now they're basing, if you want to call it that way, and now they're starting to show some renewed interest, money flowing out of the more expensive growth-oriented names and back into some of the more of the defensive, dividend-paying names, the tried and true blue chip sort of names, if you want to call them that, or that shift away, like Brett was just talking about, away from growth and into value. So it's really that's the charts are showing exactly that. It's not the first time we've seen this before. It's happened multiple times over the course of the last year and a half, 2 years off the March 2020 lows, and I don't really suspect much is going to change. I think as long as you continue to focus on relative strength for buying opportunities and ride those trends out for as long as they last, and then relative weakness for potential shorting opportunities, you should be on the right side of the market for the most part. Bigger picture, what is that going to lead to? I've said this before. I think we're long overdue for a sideways range in this market. The markets don't have to necessarily go up all the time. They don't have to go straight down. I think if you go back to 2015, that was the last time that I could tell on the charts that the S&P went sideways for over 6 months. And yes, it was choppy. It was a little frustrating, but that was the result of a lot of sector rotations, true sector rotations going on in the market. And I think, with the prospects of rising rates and inflationary concerns and a lot of different opinions floating out there about what the market's going to do, I think the sideways ranging market is in store for us for 2022, at least the first couple months.
All right, Craig, from your world, you obviously have been following growth stocks for some time now. They have been getting beat up. Is there any areas in particular that you're noticing perhaps either being oversold or that could perhaps play a little bit of catch up coming up in the next couple of weeks?
They're certainly oversold, especially when we look at like the SaaS, software as a service, cloud stocks. Next couple of weeks, I don't, you know, sure it's due for a bounce, but this is all kind of all this volatility and this pretty severe sell-off, followed not only a very strong year or two, but 5 or 6 year period where multiples were expanding. And now that the Fed has, shifted, it's going to take months or a quarter or two to really play out. I mean, obviously this has been priced in awfully quickly. Um, Seeing that there's this golden data that hedge fund net exposure, I mentioned this morning, hedge fund net exposure to both the growth factor and TMT, technology, media, telecom, is reported is at the lowest level in 5 years. And it's I think it was 5% below the S&P 500 exposure. So I mean, these are just completely blown out now, and the median forward revenue multiple for these SaaS stocks, which is how we value them, is back to pre-COVID levels. So I do think that this is going to set up a lot of great buying opportunities here this year, and I think you can start to accumulate them. Yes, we are potentially due for a nice bounce, but if you're talking about a couple of weeks, I don't really have a ton of faith over a 2 week period. But I do think it makes sense to start accumulating these stocks here, because I mean I do agree with Scott that we are due for some more consolidation this year. We've been conditioned over the last, coming out of the financial crisis and then coming out of the pandemic, that the Fed has generally had our back and every dip has gotten bought. But at this point, even though the economy is going to remain strong, obviously there's this shift into value stocks, based on what is expected to happen in the coming quarters. So I really don't, I don't have confidence that we're just going to keep buying the dip here and setting new highs necessarily. The market, if you look at S&P 500, is trading at a little bit over 21 times 2022 earnings, this year's earnings. So, now that the Fed becomes a headwind instead of having our back for the last almost 2 years, I think it's reasonable to question whether or not over 21 times earnings is cheap. So, we've seen this severe washout in the software space, and the QQQ kind of finally cracked yesterday. So I wouldn't be surprised if we see more consolidation in the coming months and quarters. But when it comes to a shorter time period, I don't have a ton of confidence in any direction necessarily.
Okay. Damon, for your world, I know you always like to jump in these distressed assets. I don't think we're necessarily seeing anything that's particularly distressed, certainly pulling off of extreme highs and valuations. But what areas of the market are you looking at for opportunities given this recent pullback?
Take a guess.
I'm going to be saying SPACs. And but I would be curious too if like you're seeing like cloud computing or it seems like you're jumping in a number of metaverse plays as of late. So what's going on in your world of the SPACs, and what other I hate using the term distressed, but oversold assets, I guess we could say, that you're looking at in terms of intraday trades coming up?
Well, so yeah, I'm still following the SPACs very closely. They've been devastated, and you have a combination of companies that de-SPAC and the stock plunges below 10. I mean, I'd say most of the SPACs, all things equal, they end up trading down to $7 to $8 following the de-SPAC. Then you have some that have maybe posted light numbers or growth numbers that just weren't as exciting as people expected, maybe pushes it down to 4 or 5. And then you get a major sell off like we've seen over the past few weeks. And now you have names at 2, 3, $4. So again, one of the reasons I like the SPACs is because most of these names are very early in their story. And so one of the goals is really just to follow that story very closely. And if you can buy some of these names at 2, 3, $4, buy the warrants at 30, 40, 50 cents, and just track that story really closely and get there early for when the turn occurs, right? Like maybe they start to post really compelling growth numbers, or maybe they get a contract, some type of catalyst that gets the name going. These are the types of names you can make 2, 3, 4, 5x times your money on. And so that's why I'm fascinated by them. That's why I continue to follow them so closely. And as I noted this morning, like, I'm excited to see them falling. The further they go down, the more opportunity exists, and it removes some of the risk, because even in a short-term rally scenario, you can get 50 to 75% on a move higher, just a general market bounce, without there being anything new to the story. So once you add in trying to identify the types of names that are actually hitting their guidance and surprising to the upside, they kind of become like IPOs, where you have an IPO that comes out, people are kind of have lackluster feelings about it, but then they start delivering really strong numbers, and that thing takes off and goes up triple digits. That's the way I'm looking at the SPACs. And I'm also starting to look at IPOs as well. I mean, typically, when you get this type of reset in the market, IPOs start to price at more conservative levels, which gives the opportunity for upside on strong earnings.
Greg, we got any big IPOs coming out anytime soon?
I think it is going to be another strong year, but I am not exactly sure near term in the next week or two if we have any big ones. But I know that the pipeline in the private market is still pretty strong, so it's just a matter of time. I mean, I would assume that some people, especially in the software space, are a little scared right now, in the near term, but it's just a matter of time before, unless things really get ugly. But I don't see any scheduled to come in the next week or two.
Okay, yeah, and I haven't heard of anybody canceling IPOs yet, so I mean, still obviously moving forward with the plans. All right, let's talk about the price action over the last couple of days, because I know a lot of people are watching that. When we were watching a Santa Claus rally, definitely the leaders were a little concerning for me, where you had home builders and defensives basically taking the lead on most days. And when they weren't in the lead, it was generally oversold tech names like ARC and IGV tend to be the leaders. So, Brett, when you're looking at yesterday's price action, we've talked a lot about the rotation out from tech into cyclicals, and that had continued early on, where we certainly saw the S&P and Dow outperforming the Nasdaq. But yesterday afternoon was interesting, as we saw eventually those cyclicals give way to tech, and then everything just kind of collapsed later on in the afternoon. Would you view that at all as margin call opportunity? Do you think we've gotten that flush with yesterday's move? Is it too early to tell, or what are you going to be looking at to decide on that?
Well, so I mean, I want to watch the way that the order flows happen. I think that, again, I think a lot of what's pressuring things is more institutional, and we hit these threshold points where then it becomes retail in a flush. And we talked about this before, where you get higher, tighter margin calls because so much more of the, let's say, the weaker handed or uh, uh, shallower pocketed part of the market is doing so much with leveraged derivatives, particularly the options market. And we've talked about this for the last year and a half. There's been a shift fundamentally in terms of how retail market participants are approaching the market, and there's much greater percentage of it that is using options. And what that really means is the margin calls are going to come faster and tighter and higher up. If you've got people stacking these momentum trades where they're going to get rich because they get so levered up in something that's breaking out and the market turns on them, there's a relatively short leash before you start getting margined out of stuff. So we have seen where maybe 10 years ago we would have to see a plodding 5% downward trend before we hit the puke day. Now we're seeing, the second day, 1.5% off the highs, we start to get a little bit of a puke day. So there's that dynamic in there, but there's nothing to say that there won't continue to be that institutional offer sitting in the market, at least as we see rates moving higher. And I think that there's a lot of intermarket dynamics right now that are going to be really critical to observe. We're going to see a lot of correlations. You're going to see a lot of inverse correlation with rates, and that's for both the risk parity reallocation and also the growth to value the growth to value reallocation. I wonder, in the chart, are you able to put up the IWD to IWF ratio chart?
I don't have, won't be able to put that up fast enough
Okay.
probably for the
Okay.
discussion, but
Oh, that's okay. Because I think it's just this enormous breakout off the lows, and I think it's the easiest way. Maybe I'll post a chart later that just shows it, because some people maybe have difficult time getting ratio charts, but it's really a dramatic shift. But like Scott said, we've seen this before. We saw it actually in I think February to March of last year. We don't see it that often, but occasionally we see these spikes in that chart. And a lot of times it's a short-lived phenomenon. And this may turn out over the long run to be that way, because IWD to IWF, Scott. Yeah, so and that's the Russell 1000 value to the Russell 1000 growth, which is, I think, the easiest way to see this shift. Either way, that's the fundamental thing that's happening. And I think that there's going to be a huge correlation to rates, and I think that there's a lot of questions around how the bond market's going to handle increased volatility, particularly when the Fed has made the pivot that they have.
yeah, another way of looking at this, Brett, too. I don't know if you've ever compared the RSP to the SPY, where the
Sure, the
RSP is the equal
equal
weighted.
weighted. Yeah,
Yeah,
right.
so that takes out that heavy 27% weighting we've got on the top 8 names, which are primarily tech names, of course. So another way, but we'll get that chart out to people.
It's up there right now. I just took control.
You took control. Okay,
Yeah.
perfect.
So you can see how the IWD, IWF. This was what again, Brett? The small cap what?
This is not small cap. It's Russell 1000,
Okay.
not Russell 2000. So Russell 1000, the largest companies in the Russell, to the Russell 1000 value ratio to the Russell 1000 growth.
Right. So value is starting to outperform.
Yeah.
for
And
the
if you look
first
at like
time.
the weekly chart, you can see that growth has just been trouncing value forever
Right.
until we've got this kind of shift. So
Right.
yeah, it's
And then Gavin, you just mentioned the RSP to the SPY, which is
Yes,
that's the equal weighted to the
equal weighted to the weighted
weighted,
SPY index, exactly.
and you're starting to see equal weight come about, which tells you that the heavyweights, mostly your FANG stocks,
Financials and energy and stuff.
yeah,
Yeah.
they're starting to underperform in that way, right?
All right, Scott. So let's pull you into this discussion here.
Mhm.
Obviously, from a chart perspective, looking at the 50-day moving average here for the S&P, for the Nasdaq, I'm finding these December lows around the 15,500 area, we'll call it, setting up as key levels. And then also for the Dow, certainly holding up the best, looking at 35,800 as a possible area, and their own 50-day moving average at 35,675, which isn't all that far away at this point. But what are the levels that you're looking at? Do you find that there's been a lot of technical damage here, or do you think this is just kind of a short-term correction that's still playing within the longer term scheme of things?
It's definitely a tale of two tapes or three tapes, whichever markets you're looking at. And so if we just go back to small caps, IWM, because this has really been the one of the telltale signs of the strength behind the market, I think, for the last year or so. If you look at throughout 2021, small caps IWM have gone virtually or reality's way pace sideways, tried to break out there in early November, but then started to succumbed to weakness and then went through that aggressive correction phase during Thanksgiving, and then have been chopping around here. Now that green line there is the 50-day moving average, which I definitely constantly reminding everyone on Trader Audio all the time that this is the line in the sand for whether you should be a little bit more focused on bullish sort of strategies or tactical approaches, or whether you should be more bearish in the market. And small caps IWM has really struggled here throughout December and just continues to succumb to downside activity below the 50-day moving average. So with this group being considered the more speculative asset class, this does suggest that money is a little bit more defensive posturing, favoring more large cap established companies, and these more speculative names. It tells you that there's almost a little bit of a risk off sort of approach to portfolio investing at this time. So it's just something to keep in the back of your mind there. As for the rest of the market, the Nasdaq, obviously, we saw this take a pretty big hit there, and we did see them come back in below their 50-day moving averages yesterday, but they've yet to take out key support level. They have not taken out the December lows that were in play that lined up with those September highs right around that 380, 375 vicinity. So until we start breaking down and start dropping below the November lows and undercutting this in more of an aggressive fashion, I'm going to say we're just kind of more in this sideways sort of range for the Nasdaq. I wouldn't really say we've seen a whole lot of technical damage, but again, it depends on where you're looking. If you're looking at software, cloud related names, obviously they've been hard hit. But if you're looking over at semiconductors, the SMH, they just pulled back to their 50-day moving average. I did pick up a long down here this morning on signs of that it was reversing off of it, because I'm banking on the fact that this is the one group that's going to still hold up and maintain relative strength. And if the Nasdaq does bounce back another day or two, I suspect the leaders in this market, which still remains a lot of these semiconductors. A lot of these semiconductor names that broke out recently the last couple of weeks in Q4, that they're still going to maintain some of their leadership qualities and potentially have the market move back to the upside there on any sort of tech rally. You switch around to the S&P, obviously, it's just going to be more of a sideways ranging activity. It did test a 50-day moving average as well today, and you're starting to see that's pretty much a short-term line in the sand that has to hold. If we start to succumb to furthest downside underneath this morning low here, then yeah, we're probably going to slip back down somewhere to the December lows. And at that point in time, we'll just have to reassess the situation and see if that's going to be due for more of that sideways sort of trading activity that I'm anticipating here throughout Q1. The Dow, the DIA, obviously, have your leaders there. This is actually one of the strongest indices out there, and this is probably because it's most diversified. It doesn't have a very strong weighting in technology-based names. It has a lot of industrials and financials and energy, and therefore we've seen these move higher. Staples as well. So it is kind of utilities, et cetera. So we've seen this kind of strength and rotation go into a few of these names. One of these stocks here lately, Gavin, is Caterpillar. I believe this is a name that you've talked about a couple of
Yeah,
times.
I'm in Caterpillar right
And
now.
IBM is another one
Yeah.
that I know you're also involved in, that you've been talking about, saying how it's due for this turnaround here the last couple of weeks. And
Visa
Caterpillar,
as well. Another
which
one
one?
at Visa as
Visa,
well.
right? That got beaten down
Another one
pretty
that,
hard, but it's bouncing
yeah.
back with financials. So yeah, it's definitely, like I said, it's a tale of many tapes, I guess you can call it, which goes all the way back to that sector rotation theme I kicked off with. You have to, when markets get kind of choppy like this, you're really just better off focusing on certain industries. I don't tend to buck those trends. I try to go with the momentum as much as possible. Short-term day trading, I mean, obviously that's a different approach to things, but from a swing trading and portfolio positioning approach, there's a lot of themes out here and a lot of rotations that I think you can capitalize on, and that's really a few of them that are just standing out here early on to start the year.
Can I just add one thing?
Yeah.
Yeah.
When you're looking at this rotation, I would say it's important to point out that it isn't tech that's getting hit really as much as it is whatever you are. If you're a company that's built to win big years from now, then you're getting crushed right now.
Because you're
But
borrowing money.
well,
Right.
yeah, and
So
also because you're we've got the argument that I made initially where you're looking at these big funds that use a discounted cash flow model and they extrapolate backwards, they discount to present value now, and if the risk-free rate of return, so bond market rates go up, the risk-free rate of return goes up, the math just changes, and you're forfeiting all of that immediate cash flow for taking on the risk of a company that may never really make good on its value proposition, but if it does, will make huge amounts later. So as rates go up, that forfeit, that penalty becomes bigger and bigger. So semiconductors and Apple, I mean, they're already generating huge cash for investors, so they're not really
Right.
part of it. But look at like ARK, ARKK.
Yep,
That's
exactly.
like ground zero of what's happening.
Exactly. Yeah, all the ARC funds, right?
Yeah. Okay. I got a question for Craig and Damon here to start us off on the next discussion, but I figured we might as well get a quick real time thought from you. Brett Mary Daly, Fed Governor, making some comments right now. Two lines that I'm finding interesting, where she says, "We've come to the point where it's clear inflation is rising in sectors not affected
Yeah.
directly by COVID," but also saying, "If we act too quickly to combat excessive inflation, we won't be able to fix supply chain issues," and says if we act too aggressively to offset actually sorry, the other one was where is I'm just missing the line here. But basically what she's talking about is raising a little bit of red flag of acting too quickly and how that could offset growth and impact the supply chain issues further. You find that interesting? You think we're going to get a little bit of the Fed reining in some of these rate expectations moving forward?
I think we are seeing the beginning of the next phase of this process, which is they're still going to do what they're going to do, but they're starting to use communications to try to smooth out the transition for asset markets. So, like, we understand that a policy error could be problematic. We get that. We're going to get, like, even though they've still got to move on what they're going to move on. So, I think probably we're starting to see messaging flip and take the other role, right? So when they were not doing anything and inflation was rising, they would continue to not do anything, but they would say, "We take inflation seriously," and now they're going to be acting. And so now the communications pathway has to jawbone in the opposite direction. That's what I see between the
Yeah,
lines here.
yeah. No, I completely agree with that. All right, Craig. Taking a look, and we just posted the Mary Daly comments in the 1233 to the in-play page. Craig, you obviously follow the growth sector pretty closely. You've got some very long-term plays in here. What kind of actions do you take in an environment like this just to kind of protect to the downside? Are you buying puts to offset some near-term losses? And how do you manage? Like for me, I'm in Matterport. Stock took off. Now it's obviously reversed back aggressively, and now I'm down in the name. But I'm looking at this as a long-term thematic play that I'd be more interested in adding on this dip because I just think that it's going to continue to build out here, and this is a little bit of a short-term paper loss. How are you handling some of the growth names in your portfolio at this juncture?
Well, I did start kind of shorting things a couple months ago, but fortunately, I don't have as much patience holding on the short side. So, I was kind of early in things like net and snow, and I've covered. And I am holding some bags that I wish would have sold earlier, like a Zoom or even TDoc. But if, like you said, if you believe in the company long term, then it's an opportunity. So in situations like this, I kind of want to just more focus on highest conviction stocks to load up on. During the pandemic, it was Elastic, ESTC, and now we're seeing a ton of similar setups in recent IPOs that are just washed out below where they initially traded, and they might have doubled and now they've gotten cut in half. So it you really got to respect the technicals in order to avoid experiencing big drawdowns. So I haven't necessarily done a great job in that. But at this point, I'm just going to try and focus on my highest conviction plays.
All right, Damon, how about you in the scalp space?
So, I mean, I guess the big thing is just trying to recognize what type of market you're in, and as I've been saying, probably for about a year now, I don't mind missing out on certain things in terms of not participating in market moves, and so I've been heavily cash for a while now, and I've had the most success doing research, heavy research on names and accumulating them aggressively into pullbacks when no one else loves them, cares about them, and maybe you're buying something at $1 or $2 that can go to 10 or 20 bucks. I mean, I still have names in the portfolio from 2 years ago that are up 5, 6, 700%, 1,000%. So I don't mind stocks going down, and typically, well, pretty much always, I scale into positions. So I usually start with swing trades with a third of a position, and I continue to follow the story over time. I'm on every conference call, looking at every earnings report, every press release, really just getting a feel for the company. And so when a lot of times you'll have names that were hot for a while, but then their technicals turn south and people forget about them. Maybe they have one bad quarter, or maybe that group is just out of favor and the hot money is not paying attention to it anymore. I'm still following it. I mean, I'm actively following probably 150 names, right? And so someone asked on the feedback, like, how do I know like which names to put money into? Well, I'm following them constantly. I may be following them for quarters. I may be following them for years, looking for the right time to load the boat. And so that process requires patience. But I've just found after, I've been doing this for 20 something years, uh, like the returns on that particular strategy are compelling. And so, I focus on, I do a lot of intraday trading, looking for short-term technical reversals or short-term price momentum. But at the end of the day, my core strategy is distressed and relative value and looking for those names that have the opportunity to return multiples on your investment.
Okay, just keeping an eye out on price action here. We are pushing two session highs following those Mary Daly comments. Not saying that that's the only reason why we're moving higher here, but we have just popped higher over the last 5 minutes now at 47.14 in the S&P, and Nasdaq up to 15,876, getting close to session highs, which were 15,895, set back at 11.15. So, Brett, how are you looking to play this current environment here? I know you've separated your trading portfolio for your long term portfolio. Are you even taking any actions in your longer term portfolio? And what are you setting up for in your shorter futures activity?
I am not taking any actions in my longer term portfolio. I remain really no leverage, very broad, very top down, exposed to global risk assets on the long side, and slightly less so than I was at the beginning of last year. So midway through last year, I reduced somewhat. Otherwise, my strategy right now is I think that I've positioned myself for something that seems a little bit contradictory, but I really like both positions, and sometimes that happens, and that's long crude oil and long the dollar. And crude oil has been just awesome off of that puke. Um, and we quickly picked up about 20% on that position, and it looks like it's just continuing to trend higher. We're already back above where we were when they did the SPR release. So that lasted a few weeks, and that was helped by Omicron, and we're already back above that. So I think the long-term bullish dynamic in crude oil market continues to be something I'm behind. And I just like the sort of trending uh, situation right now in terms of the setup for the euro short, which is the way that I'm long the dollar at the same time. And otherwise, it's just taking it day by day and looking for intraday scalping opportunities. I mean, we've got decent volatility. We've got a lot of little opportunities. I've been very successful over the last few weeks, just kind of sniping in the equity index futures market, and it's been a really great strategy. So I'm just staying with that, read and react each day.
Scott, how about you? What's your take for protecting your portfolio to the downside?
I'm actually not protecting it too much, although I have been diving a little bit into gold recently. Gold has been basically sideways. It's not really acting as the safe haven that we've all grown accustomed to over decades. Seems like a lot of money maybe be flowing into some cryptocurrency as the alternative non-correlated or negatively correlated assets when markets go weaker. So it does seem to be losing some of its luster. No pun intended. But I think gold, that's the only place I've really been kind of moving into more of a sort of defensive posturing in my portfolio. Otherwise, I'm in the same camp here. I'm really sitting on my hands here. I know we came up with a lot of different names that we were looking for as various um, tax loss selling and potential new buys into the new year. And I haven't pulled the trigger on any of them yet. I mean, we came up with at least 25, 30 on Trader Audio over the last couple of weeks here, from DraftKings to Palantir. There's been a number of them, and that they just don't look good, and that's the catch here, is that they've underperformed. And like we said, a lot of these ARK investments, or these names that are destined for big growth in coming decades and stuff like that, they haven't turned that corner yet. There seems like the hype of the story is still dragging on them, and you need to still to have some more flush outs of people giving up on them in order for them to turn around, and that could take some time overall. So from a bigger picture portfolio standpoint, I'm really just kind of maintaining the status quo here. I don't see any major underlying uptrends that have been in play. With the markets at their highs. I'm also, I like to watch sentiment. I think it's kind of ironic how the large cap indices are at all-time highs, and yet there's this constant concern about how much higher it's going to go. And basic sentiment says when the market peaks during euphoric phases, when everyone's exciting, when your mailman and your taxi drivers talking about the market, and your family's talking about it during gatherings and stuff like that, who have no business, as a full-time job, about the market. When everyone's talking about it and the market's at its highs, that's the time you want to be nervous. Instead, we're at the market at the highs here, and everyone's concerned about interest rates going from extremely historical low rates to just a little bit higher, which again is still a really good environment. And a little bit of inflation in the long run isn't the worst thing. It tells you the economy is on a recovery sort of mode there. So I'm still maintaining this bigger picture sort of bullish tone. And then I also saw a study over the weekend too, where uh, the years that the market has returned more than, I think, 20 or 25%, there's an 86% chance that the market is going to be positive in the following year. And so with returns of over 25% last year in the S&P, there's a very high probability that that bullish sort of vibe is going to be maintained, that these conditions are going to be played out. Again, for me, from a shorter term, for the trading service and swing trading and day trading, it's really just coming right down to the industries, looking at the sector rotations, and just playing, the classic technical patterns, the breakouts and the pullbacks.
All right. Let's take a look then. Moving forward to 2022. Craig, we'll start with you. What's your theme that you're looking for? Is there any particular area that you're going to be paying closer attention to?
Well, I will remain focused on the software stocks. Like I said, I do think there's going to be a lot of opportunity in those this year. The other space is travel. I think that, as I think we've all kind of been talking about, this Omicron should be peaking here in the next week or two, and then hopefully we can put most of this pandemic behind us, and people will be itching to travel. We've already kind of seen it last year that demand is really strong, so we'll see that continued. During the pandemic, there was it's just pent up demand. So I'm still in Airbnb, and you can make a lot of the same valuation headwind arguments about Airbnb. It's not really cheap in any way. 50-ish times EBITDA for this year, so it's not a value stock. Something like $100 billion valuation, but it is going to be making money and profitable going forward. It is a leader in a category that it essentially created. So it's one of those stocks that probably won't ever get optically cheap. I think Airbnb and travel and Unity, which is are two of the more special IPOs that were about a year ago that I'm long and plan to hold long term. I don't know how much lower Airbnb can go, but if it does continue to pull back, I probably would add and buy more. But I do have a lot of positions in that whole kind of travel / leisure recovery space. Airbnb is kind of at the high end in terms of quality, in my opinion. I have some Tizu, which is a very small.
What would be your top airline play?
I do still have some Delta.
Yeah.
I do like Delta here for an eventual bounce back to 50. It's not super exciting and it's not super cheap, but I think now is a good time to buy travel stocks, and even airfares. If you're looking to travel, I think bookings are probably slow right now, and I think airfares kind of act like stocks where you kind of want to buy them when they're low and out of favor. This is the time to be buying while the Omicron is kind of in the headlines, because hopefully February, March, and for the rest of the year, travel will be red hot like it was last year. Who knows what happens in the fall or next winter? It seems like maybe things will come back around. We'll get another variant, but for now, I think travel demand will remain strong. So, I have Airbnb and Tizu. I still have Delta, Lyft. Uber's another way to play it. I still have some Expedia and Disney. So, anything that is reasonably valued. And again, you can make the case that Airbnb isn't cheap at 100 billion, but it was a lot better than Rivian at 100 billion with no product, or with barely any sales.
I think they had 700,000 in sales, Craig. To be fair,
Okay,
I
sorry.
think most of it was T-shirts, though.
Yeah, I don't. I mean, I've I've made my case on Airbnb before, so I do think it's a year to be long travel, to remain long travel, and I think that'll probably going to be true for intermediate to long term here. People weren't allowed to travel for a short period of time, and now everybody's going to be itching for years to get back, whether it be overseas or domestic. And yeah, I think there's going to be a ton of opportunity in the software space here now that we've seen this washout. Not necessarily, but I think that might require a little bit more patience.
Okay.
Hey, Gav, let me just jump in there. So
Sure.
some of the, because I know that's obviously he's got some good picks there. If anybody's interested in the ETFs in that whole space there, there's a few that I track. One of them is BEDS, BEDZ. That's the hotel ETF. It's fairly new. It came out just about 9 months ago. I have it showing up here on the charts. That's BEDZ. Another one that we track a lot, we talk about the leisure and entertainment ETF, PEJ. That's Peter Echo James. Again, some you have stuff from like restaurants to Disney to Marriott hotels in there. And then the other one that was fairly new, it's not too much volume that I came across, is TRYP, TRYP. That's Tango Robert Yellow Peter. This made its debut, looks like in May of last year, but this incorporates airlines, hotels, and cruise lines. That's TRYP. So you have a nice diversified little portfolio there. And then, of course, if you just want to play straight up airlines, you have the Jets ETF, JETS.
All right, Damon, for you, where are you looking in particular for some of these SPACs? Is there any industry that's jumping off the plate to you?
It doesn't really matter to me. One of the reasons I do like the SPACs is that the names do kind of focus across industries. So, I'm looking at stuff from healthcare to financials to rockets to what else do we have on the board here? Insurance tech, fintech. There's a lot of stuff out there, and so really it's about finding the depressed stock price that connects with the story that the market got wrong, right? And when you get those two pieces fitting together and getting there early, then the momentum crowd kind of getting behind it after it starts to move, you can get pretty rapid price appreciation. Another area that I'm really paying attention to, typically in past years, I've run an income portfolio specifically focused on high yield, a lot of preferreds, publicly traded bonds. Interest rates, the coupons these have been offering have been so low that I've stayed away, understanding that when rates go up, a lot of these things will blow up. And so that's one trade I'm looking for this year as rates start to climb. You'll see some of this new paper that came to market, high yield paper that came to market at 4, 5, 6% for relatively risky companies. And so a preferred that was issued at $25. If you get a route in these types of names, you could see them fall to $12 to $15, which can create pretty compelling opportunities. So at that point, I start to sift through the names, really dig into the story. And if I can buy a preferred that's you kind of get a price route where everyone's just getting washed out of these things. You're getting margin calls. A couple of years ago, we were buying preferreds, $25 preferreds at $4, $5, that have come all the way back to par or above par. So stuff you bought at 5 is trading at 27 now. We bought at 8 is trading at 27, 28 now. What I'm looking for this time around will be things that fall to 12 to 15 that will rebound to say 20 to 22, be able to lock in a decent yield based on where you bought it, and also pretty strong capital appreciation.
Any thoughts on crypto with this recent washout?
You know, I don't follow crypto that closely any longer. Yeah, so I don't have a strong opinion.
Okay, fair enough. Brett, do you still view energy? I know a lot of people have been talking about energy being the top performer in 2021. You think this has some further legs with oil and energy?
I mean, I do. Yeah, I think I don't know. There's going to be some hiccups because we're going to get to points where it's sort of crowded, and that's gonna set up some pullbacks. But I think that the larger dynamic that's happening is the same. It's in place. It's what we've been talking about since, I mean, really going back to you and I on our Sentiment Flow show back to late summer 2020. Really, I mean, it's the same dynamic where you've got a lot of companies that have shifted to a different sort of model where they're not willing to increase production nearly as aggressively, even on higher prices, and it puts all the power into OPEC's hands. They've had unprecedented power because they got the OPEC plus structure in place now when they don't really need it at this point. Because of the collapse in the U.S. shale industry, so you have so much power concentrated at OPEC plus, and I think they're more than willing to run it up to triple digits, and I think that they're going to be able to. So that's one dynamic. But one thing, for if we're just panning back to 2022, I wanted to talk about this. So there's one dynamic that I think is going to be really important in shaping how this year goes. And I wanted to explain it really quick. And I talked about this in one of my ETF daily notes a few days ago, but I just wanted to kind of put it into this conversation. I think there's a real possibility of a real sort of Goldilocks outcome. If Omicron is fast, candle that burns twice as bright and half as long, flames out quickly after becoming sort of the clear dominant strain around the world, that could spark a faster recovery in supply chains. It could push back on inflationary pressure. It could give the Fed some breathing room, and everything kind of falls into place this year. And that's one universe. But there's a different universe that's much worse, that where everything stretches out. And other analysts have been talking about this, so I don't want to take credit as my idea. I just really agree with it. And the central risk is how China chooses to deal with Omicron, because they're the central base for so many major global supply chains. And they've had a different strategy for COVID all along, where because they're this sort of authoritarian state, they can have lockdowns that are really much more effective. You know, people stay in their homes, they go out for 5 minutes to get some food, they go back in their homes, nobody's allowed to do anything else. And it stops the virus. And they've done that in previous waves. But Omicron, just according to analysis I've seen and according to what we're already starting to see, we're seeing community spread now in China. It's just too contagious for that strategy to work. So either China will shift to a mitigation and management strategy rather than staying with this sort of iron fisted zero COVID kind of strategy, which is a losing battle, or they'll stick with this strategy and fight that losing battle. And either way, the same thing's going to happen, in that there's going to be an eventual widespread breakout of Omicron in China. But if they shift to a management and mitigation strategy, higher vaccination rates, and kind of, you know, trying to manage the process that it's going to spread, and they don't go with such strict lockdowns, it will be a faster dynamic, and some global supply chains will heal much faster. But if they keep fighting this way, it's going to extend this whole process. It's going to keep the pressure on the Fed, and it's going to run a higher risk of shifting long-term inflation expectations higher in other areas of the world. And I think that we're going to see the evolution of how the COVID data during the Omicron wave goes in China, and how their response to it is strategically, as really a central dividing line in terms of how 2022 goes for markets.
All right. And then, Scott, finally with you. You were talking about your thought that we could be in for a period of consolidation, something similar to what we saw in 2015.
Yeah.
If that's the case, what's your overall kind of playbook thoughts going in? Obviously, buying low and selling high would be key, right? But do you have any particular way that you're looking to attack 2022 here as we start off the new year?
No, Gav, I'm a broken record, and I just kind of ride the coattails of those of you guys around me. Just kind of going through your themes and your analysis and your research. I just try to time things a little bit better than you guys by looking at the charts. So, yeah, we go back to 2015, where I'm showing right now. You can see it started off for something somewhat similar, I guess, to the Nasdaq at this point in time, where price action early 2015 was getting back to the 50-day moving averages, that green line there. And then it just got a little bit too far oversold, too fast to the downside, about a 4 to 5% move. It bounced back, and then they sold it off again, and then it went sideways again all throughout January of 2015. And I feel like this is really kind of the playbook that we should be looking at right now. And then you've had some upside, and then this is probably earnings season here going into February, where things were looking good. We got some good earnings reports. Earnings are coming out from financials late next week. So we get this drift higher because why? The path of least resistance is to the upside. You're so close to it. And so that's probably going to be it. Then things are going to just kind of taper off, I think, going into the spring between Q1 and Q2. And we're just going to get this, kind of digestive, but it's healthy. It's the market. For the market to just settle down and just go through and absorb what's happening around it, like Brett just kind of described, with all different interest rates, with interest rates potentially going higher and the market making the slight adjustments to their long-term portfolios, but nothing going to extremes, and just kind of rolling with these punches that we're all sort of forecasting forward down the road. I think this is just kind of what we're in for. We're in for this, I would say 2 quarters at least, of just sideways sort of bullish vibe. And I'm just going to be, like I do every day, Gav, just kind of focus on the rotations, focus on the momentum, and capitalize on the short-term movements there. So, yeah.
And then we get a crash in August.
This was
Slide that chart forward, buddy.
Yeah, that was driven by something.
No, that was driven by. No, I remember that one so.
Was it Congress?
No. It was China deflation, but
Okay.
but that was just a trigger.
When they
look at that
devalued
range.
the yuan, right?
This is a 6-month range
Right.
of total 3% width.
Right.
All right, and when that happens, leverage starts to increase because you got to make money, and the only way you can make money in tiny moves is by using leverage.
Right.
And then the second we got to a thin period in August, we cracked. And because people were using so much leverage and the market was thin, we got a 10% down move in the Dow in 3 days.
Yeah, but we'll be short by then. Don't worry.
Yeah.
When that happens, we'll be all over it. Then we'll be flipping out our longs. We'll be hedged, or protecting our longs, and we'll be short the market the way down. So
sure.
we'll be reading it just like we do every single day. So I'll be fine. I don't predict those stuff. I just go with the flow.
There you go.
Make the necessary
adjustments.
adjustments.
And I like your overall prognosis. I mean, I think we're due for some kind of non-directional market.
Yeah, and not to mention, the Roaring 20s, 1920s, almost 100 years ago. Wow, it's kind of weird saying that. That came out of the pandemic, out of the Spanish flu pandemic. So just something else to kind of keep in the back of your mind there, that the economy was reopening and people were just, learning to live with it and moving beyond it. So
Not in World War One.
In World War One, yeah, that helps too.
Well, I just had a couple of things I wanted to mention. Going back to Brett, what you were talking about with China, I guess it's unfortunate timing because they have the Olympics.
Yeah, I know, right? And the Lunar New Year. Yeah.
So,
and it's going to make it really unmanageable to do what they're trying to do, but they're still trying to do it.
Throw and try to manage that property development issue too for China.
Well, so what I was going to get, this is actually kind of 2 points that I was going to make. So there was the news about Micron's production being shut down, or I think maybe it was Samsung Pier, which is kind of actually bullish for Micron because it limits supply of either NAND or DRAM, right? So they did, and it was the most 15th populous city that they're just trying to shut down because of an outbreak. That was like a week ago or earlier this week. So I mean, if they're trying to do that there, one would assume they're trying to do this ahead of. They're going to keep trying to contain it ahead of the Olympics and the New Year, which kind of
right
coincide with each other in early February. So, but because it's so contagious, moving so quick, they're not going to be able to do it. I mean, the next few weeks.
I think the hope is that post Olympics they'll shift strategy, and we'll just see if that happens.
Okay, yeah, that makes sense. And then that was bringing me to my other point, Scott. This is kind of more up your alley, and I'm not sure, Gavin, if you're still in this. Is Micron, which is a semi which is like Scott said, hasn't really pulled back at all. There's relative strength in semis, and among semis, Micron MU is really the cheapest chip stock there is. And obviously there's a reason for that in terms of commoditization, supply and demand. But their last quarter seemed to be pretty bullish, and this thing just really hasn't pulled back at all, and it's still trading at 5 times EBITDA, 10 times earnings. So it's possible that we see a re-rating here.
You got to throw in Qualcomm on that too, Craig, and they got some really interesting items with the chip build out and some of the new chips that they're going. So Qualcomm's also in that category where it hasn't really pulled back.
Yeah. Yep. So those are worth monitoring here. If things do stabilize, I guess we could see new highs there.
All right. So anybody else with anything else to add?
Where do I get one of those Rivian t-shirts?
I'll buy you one, Scott.
Right.
Drive up the comps for next year. Yeah, so I think that's going to do it unless anybody else has anything else at this point. All right. We will be posting this to the site here shortly. I should have it up and ready to go in the next 10, 15 minutes for anybody that might have missed anything. Did my best here to kind of take notes and lay out where things are said at certain minutes, but definitely a worthwhile hour for everybody to listen to. If there's any questions, feel free to write into the team. We're more than happy to answer them. And to all the traders, thanks for jumping on here and going through this. It's a good start to the year for everybody and should allow everybody some good information to bite into as we kick off 2022.
All right, thanks, Gav.
Okay, take care. Bye.
Bye-bye.
All right, Event Trader here. We are going to stop the stream momentarily, and I'll be starting it back up here in about 5 minutes.